Insiders creating the exit. For 15 years, the legacy financial system kept pre-public tech allocations strictly behind closed doors. If you weren't a Tier 1 venture fund, a sovereign wealth entity, or an ultra-high net worth insider, you couldn't access a company like SpaceX before it hit the public equity boards. But Wall Street just rewritten the rules urgently, cutting the IPO access threshold from $500,000 to $2,000, a massive 99.6% drop. The noise says crypto has no real-world utility and is dead. The signal is that Wall Street market makers and smart money traders are actively using decentralized order books to hedge positions, lock in massive arbitrage profits, and gain borderless equity exposure before the physical stock market can even open its doors. While traditional markets are selling you a $2 trillion dream built on a $5 billion annual loss, decentralized protocols are generating $1 billion in positive, high-fidelity revenue at a $57 billion valuation. Today, we dive deep into this historic sentiment divide. We run a surgical comparative analysis. The $2 trillion valuation of SpaceX fueled by hope, hardware, and deep cyclical losses, against the $57 billion valuation of Hyperliquid, a relentless, cash-positive on-chain derivatives machine. We break down the mathematics of revenue versus narratives, analyze why institutions are prioritizing actual chain utility over speculative hype, and map out exactly how to position your portfolio for the eventual merger of legacy finance and public ledgers. Welcome back to the Signal and Noise podcast. My name is Newell. Make sure you are subscribed. Let's dive in. Let's start with the absolute biggest story dominating the quantitative side of financial media today: the monumental SpaceX pre-IPO narrative. Ahead of the highly anticipated public listing, decentralized perpetual platforms, most notably Hyperliquid, have pioneered synthetic pre-IPO futures markets. With the official IPO pricing pegged at $135 per share, the on-chain market has aggressively repriced the asset. Traders are slamming the buy buttons on perps, pushing the $SPCX contract past $180. That is a massive 33% premium trading live on a decentralized ledger before a single physical share has cleared the legacy stock exchanges. While the narrative claims SpaceX is creating the future of interstellar travel, the cold quantitative reality is that it is commanding a $2 trillion valuation while burning through $5 billion annually in operational losses. This isn't an investment opportunity, it is a textbook capital trap. Insiders need liquidity and funds need allocation. Wall Street just opened the gateway to regular investors, not to give retail a gift, but to create buyers for when the insiders sell their exit. The bag holder protocol has been activated. Now let's pivot from the legacy narrative that values hope over hard numbers to the protocol anchoring the opposite end of the spectrum, Hyperliquid. Anchor your perspective. Any protocol displaying high positive revenue during rough market conditions demands a permanent spot on your close watch list. It is the absolute bargain value of this cycle. While the $2 trillion tech darling SpaceX sits at number 1 in valuation with a staggering $56.4 million in annual losses. At number 8, Hyperliquid, the premier routing matrix of Solana, managing the vast majority of all ecosystem trading volume, is clocking a relentless $1 billion in positive LTM revenue. Because a decentralized derivatives platform generates fees on the velocity of capital rather than the asset's nominal price, its revenue engine runs constantly, entirely unbothered by market trends. As programmatic trading volume swells by an anticipated 10 times to 15 times, Hyperliquid sits directly at the protocol toll booth, scaling its revenues straight into 9-figure territory. Despite this cash flow supremacy, Hyperliquid commands a total valuation of just $57 billion. The quantitative signal indicates a profound underpricing relative to its operational performance. The noise is focused on token price drawdowns, but the institutional signal is that entities generating genuine financial breakthroughs are absorbing legacy liquidity. The weak hands are being systematically cleared out. This brings us to the final quantitative comparison. Where is this massive ocean of capital actually migrating? Wall Street will never pay gas fees directly in native crypto tokens. They will use abstraction layers. This completely dismantles the old retail thesis that trillions of dollars in real-world assets would directly drive up token burn rates. Capital is migrating into organic revenue-generating alternatives. Wall Street is building a highly regulated fortress. BlackRock quietly filed its Form 8-A for a brand new yield-bearing Bitcoin ETF, anticipating a launch next week. The hot money is fleeing hyper-extended AI valuations and dry crypto funding markets simultaneously. They are choosing cash flow over speculative hardware. Value is landing in organic revenue sectors like decentralized order books like Lighter at 7, commanding $11.3 million, and specialized compute like Ether Cloud at number 4. If a protocol is not an on-chain venue for real-world assets and tokenized equity, it will likely bleed to zero. The institutional rails are locking into place, and you have to understand the plumbing. When social feeds are drowning in retail despair, it is the absolute worst time to make emotional, reactive portfolio decisions. Your tactical playbook needs a complete structural update. If you are holding overvalued AI infrastructure stocks, recognize that the rotation has begun. De-risk out of overvalued tech names and look for cash flow positive, asset-backed alternatives. Strip away the unrevenue-generating applications and focus your attention on the cash flow engines like Meteora, Aave, Aerodrome, and Jupiter. When global liquidity flows back onto the blockchain, these fee-collecting protocols won't just recover, they will structurally scale to dominate the entire global financial frontier. The noise. Crypto is stuck in a speculative casino. SpaceX building private blockchains means public crypto is dead. But the signal is different. The signal. We are standing in the earliest stages of the largest monetization megatrend in human history. Institutions are turning public networks into their primary back-end settlement layers. Understand the thermodynamics of capital, position your wealth into enterprise-grade middleware, and look past the daily candles. Track the plumbing. Position yourself where the capital is landing. Stay sharp. Stay focused. That's it for this deep dive edition of the Signal and Noise podcast. My name is Noel. Please like and subscribe. We'll see you on the next block.